We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Simon Mikhailovich, long-term investor, entrepreneur, and founder of the Bullion Reserve and Bullion Source. Thanks for joining me today, Simon.
Thank you for having me, Tom.
I think a good place to start here today would be kind of discussing the idea of counterparty risk. Now, we've always spoken about this on the show in terms of the idea of, bullion storage programs that may or may not have the metal that you're entitled to. But as you recently tweeted, if you hear somebody say that it's not about credit, it's about credit. Credit and counterparty risk is the risk of default, the inability to perform as or when promised. There are many different risks that can lead to default, but in the end, any form of default is a credit event. So are the banking failures that we have already seen this year highlighting the idea of counterparty risk and the interconnectedness of many of these financial institutions?
Absolutely. In fact, you hear a lot on the on Bloomberg and CNBC where it's discussed. You hear a lot of nuanced discussions about why, let's say, Silicon Valley Bank failed, why Republic Bank failed, why last year, crypto banks, a couple of crypto banks failed. And they always say, well, it's not credit risk, it's duration risk in the case of, let's say, Silicon Valley, meaning that they bought long-term bonds and the bonds went down in value. And then people became worried about the solvency of the bank. They started withdrawing the money. The bank had to realize these unrealized losses, and suddenly it was in trouble and it had to be bailed out and shuffled into one of the larger banks. And the same thing happened with First Republic Bank the other day. And now I hear, today we hear that, there's another regional bank, Western Pacific Bank, in trouble. So the point I want to make here is that it depends on what sort of position you're looking from. So let's say, and that was the point about the counterparty risk and credit risk really being catch-all risks, which ultimately express themselves in the inability of your counterparty to perform as and when promised. But that's, by the way, the definition of counterparty risk. It's an ability of one or more parties to a transaction to perform as a when promised. Doesn't say why they can't perform. Mm-hmm. So, okay, should depositors who are about to lose their money care whether this particular bank is about to go under because of the duration risk or because of the credit risk? I mean, did they make bad decision this way or did they make bad decision that way? So from their point of view, if you elevate yourself to them, they're suffering maybe not from credit risk, but from duration risk. But if they are your counterparty, whether you're a business or a depositor, then for you, it's their inability to perform vis-a-vis you for whatever reason, and that happens to be whatever their specific reason is. Then, of course, next it's going to be commercial real estate, and then it's going to be something else, and the corporate loans and whatever. So the reasons change. So I think it's very important to understand that the ultimate investment risk is not volatility, it's not price going up and down, it's permanent impairment. In other words, losing money and having no chance to recover it. Okay? Default without full recovery. That's the ultimate investment risk, losing capital permanently. And so in that sense, counterparty risk, meaning somebody who's on the other side of you is not able to perform for whatever reason that is. Now, there are two kinds of counterparty risk that's also important to understand, and credit risk. Mm-hmm. There's something called idiosyncratic risk, which pertains to a particular situation. So in other words, it's not something that's happening within the system or across multiple institutions or multiple companies. It's something that's specific to a situation. Like, for example, there's fraud. Okay, somebody stole money. That usually is called idiosyncratic risk. So it's not systemic. And then, of course, there's systemic counterparty risk when there's a chain of events that leads one counterparty to fail, and that in turn leads another counterparty and another one and another one. And that, of course, is a particular risk that especially high for the highly financialized system and economy that we have. Because under financialism, or financialization, the optimization of everything, of the real economy, of the financial arrangements towards asset prices and financial outcomes permeates everything. So, for example, this multi-trillion-dollar edifice of derivatives is a daisy chain where you have to understand how the whole system works with the hedging and the risk management, where risk managers lay off some of the risk on other institutions, and then those institutions lay off the risk on other institutions. And it's a daisy chain where any failure of one link in that chain triggers a series of failures across the chain. And that is precisely why the Fed, the Treasury, and the Central Bank of Switzerland have so far not allowed banks to really fail, right? Because if they allow, like Credit Suisse, can you imagine Credit Suisse, like some call Debit Suisse these days? Can you imagine a bank of that size with a derivative book of that size suddenly not being able to meet its obligations vis-a-vis other banks? So suddenly they thought they had net exposure, meaning they took on so much risk, they reinsured or insured that risk, just like with AIG during the subprime crisis. They reinsure, and then the insurer is not able to pay when the losses come. And so then, of course, the insurer can't meet the obligations to you. You cannot meet the obligations to the people you promised, and so on and so forth. And that's how system blows up. So I think if you want to think about what's going on, it's a massive rise in counterparty risk, and the government understands it. Governments understand it, and they're trying to federalize in the U.S. sense, to federalize this risk and take it up to the sovereign level. In other words, to stand behind the deposit so that people don't think that if they don't jump ship in time from a bank, that they're literally going to lose their deposit money. But I mean, at some point, probably not too far away, there's going to be a question about the ability of the government to essentially meet these obligations. There's $17 trillion worth of deposits just in the United States. And 50% of the assets are in the too big, like 4 or 5 too big to fail banks. 50% of all the assets. So half of those assets are in 4 institutions. So but by the way, also the size of the FDIC reserve is only like a couple of percent of deposits. So really, this is an unsecured obligation of the U.S. government, in addition to the 30 whatever trillion dollars of debt and however many trillions of unfunded liabilities. I mean, it's a faith-based initiative. It's as long as people have confidence, it can go. But it's clear from what's going on in the banking system and so far in the regional banks, that confidence is fairly quickly eroding. I mean, we've been having sort of a banking situation every few weekends now. So that's what counterparty risk, and that's what is, I think, growing and traveling up. So as the liabilities are taken to a higher and higher level, so first for the too big to fail banks, then to the government itself, the questions about the creditworthiness or the ability of these bigger and bigger entities to perform is coming into view. And I believe this is happening even though investors are not so far reacting in a way that one would expect, given the acuteness of the risks that are rising very, precipitously. It's not happening under covers. I mean, this is happening very much in front of our face. It's like seeing is not believing. People see it, but they don't believe it. That's which, by the way, is the way it's always happened in history.
Yeah, absolutely. And you said there investors aren't reacting accordingly, but I think in a lot of cases it's not only investors but depositors as well. People that don't necessarily think of themselves as exposed to risk, as exposed, in any way, shape, or form to something that they would consider risky. Yet when we see bank failures and you see what should be the outcome of an actual bank failure on a particular, let's say, one individual, that's exactly what the Fed and the Treasury are trying to avoid, is this, continuing bank run where people just pull all of their deposits out of the banking system, right?
That's what they're trying to prevent. But and look, it's a little bit like a small town teenager, whose dad is friends with the police chief. Mm-hmm. And the kid keeps getting in trouble, doing, smoking, whatever, drinking, maybe fooling around with guns at some point. And every time he gets in trouble, dad goes to his friend and buddy, and they shake a finger at the boy, and they say, or whoever it is, and they send him home. And then, of course, that kid eventually develops this sense of invulnerability, that nothing bad is ever going to happen, because every time something happens, he gets bailed out. And then eventually, maybe he does this in a different jurisdiction where dad can't bail him out. Mm-hmm. And then, whoops. And so I think this is a kind of microcosm of what's going on, where people, keep getting bailed out. So learning the wrong lesson. Mm-hmm. And we've talked about it last time. I've been talking about it for years. People learned the absolutely wrong lesson in 2008 from the lesson they should have learned. Mm-hmm. They learned that you can mess up and everything will be okay. And so if you can keep screwing up and getting bailed out from your mistakes, then what is the incentive to stop doing it? I mean, there is no incentive to, and you're making money while doing it. So why would you ever stop it? So it just keeps going and going. And that's the horrible danger that we face systemically, because you can't keep doubling down. Mm-hmm. If you keep doubling down on a bad bet, eventually, probably sooner than later, it's going to come bad. It's going to go bad. And this is kind of what is starting. And every time it tries to get going, a reality intervenes. The government continues to provide bailouts and guarantees and all kinds of stuff. Mm-hmm.
Simon, you have a great quote that I think summarizes this. It says, history and common sense suggest that bailouts will continue until confidence in governments and their script fails. So does this really galvanize the action that needs to be taken by the Treasury and the Fed to bail out any failing institution now?
Yes, there's no choice here. When I say there's no choice, of course there's a choice, but there's no choice for politicians. Mm-hmm. Because the politicians, unless, of course, well, let's give them a chance. I mean, there's right now, there's a fight over debt ceiling. As I like to say, I mean, debt ceiling is not to limit the debt. It's just to provide every so many years an opportunity for the minority or whichever side, to extract concessions from the other side in order to agree to raise the debt ceiling. Mm-hmm. So, like yesterday, I was watching TV and one of the Democratic senators was saying, well, Republicans need to, agree with us, because if we don't lift the debt ceiling, it's going to be a disaster. But the person who was interviewing didn't ask a question. What is the purpose of quote unquote debt ceiling if all it does is gets lifted? If all you do is lift it every time it approaches, I mean, why have it? Mm-hmm. It's just an opportunity to have a negotiation. That's really all it is. So I'm skeptical that there will be a situation where the debt ceiling will not be lifted and the United States will default by act of Congress, essentially, or by failure of Congress to act.
Funny enough, Simon, the last time you and I spoke was in December of 2020. And I was looking through my notes about what we discussed at that time. And we had actually touched on the debt ceiling debate, even back then, as it was occurring in Congress then. So is there anything meaningful in your eyes that could happen as part of the debate this time? Any meaningful concessions that we could actually see come out of the debate here?
If you don't mind, let me answer this question a little differently, because this kind of is a microcosm of a much bigger issue. And that is that we, in 2020 versus now, there's been a tremendous worsening, I guess, of the polarization inside the society. in the body politic, civil society. So we're essentially observing convergence of multiple trends at the same time. And while it hasn't happened in our lifetimes, this type of convergence has happened many times before. And one of the components, one of the trends that's converging is political crisis, born out of tremendous polarization between what you want to call the right and the left, or whatever, Republicans and Democrats. I don't think it's strictly along the party lines. I think it's more along the philosophical, financial, and social views of different people. And the split is almost 50-50, and it's getting deeper and deeper. And so what normally would have been just another backroom or smoke-filled room deal, I'm skeptical that something else happens here, but it's possible because of this polarization. So the convergence of the trends, one of which is political crisis, and the other, of course, is the financial crisis, which we're discussing with the banking system. Interest rates went up. Nobody should be surprised about it. Interest rates went up a lot on a relative basis. There are all kinds of carry trades out there. It's not just people or banks buying long-term treasuries. There are long-term corporate debt. There's long-term mortgages. There are all kinds of long-term debt out there, all leveraged. And so if you saw last year that the TLT, I think is the ticker, which is the it's a 20+ year treasury index ETF, was down 30, I don't remember, 30-40% at some point. I mean, just think of what kind of mark-to-market damage has been done in all of these carry trades. And yet we haven't seen a lot of the proverbial quote unquote bodies floating up. So far, it's, regional banks, the crypto, but these are sort of the weaker marginal areas. We haven't seen, and of course we saw Credit Suisse, which is not the marginal area. It's not in the US, but still. But we still haven't seen like swaths of hedge funds or private equity funds or real estate trusts. There are troubles brewing, but we haven't seen really the expression of it yet. But it's clearly there. So you have a major financial stress. You have major political inside, at least the United States, and I think in North America in general, probably. You have a geopolitical crisis, which is a major factor in what's going on. And that's another expression of counterparty risk. And if you want to talk about de-dollarization and where that comes from, we have tremendous technological disruption happening with AI and some of the very advanced, artificial intelligence, robotics systems. And then we have natural disasters. I mean, we had the pandemic. So it's like the horsemen of the apocalypse. Mm-hmm. And they're all converging at the same time. And while it's hard to pinpoint the effect of each one of these, throughout history, every 100 or so years, they have combined to produce what some call the fourth turning, some call the 100-year debt supercycle, some call the rise and fall of empires, whatever. The bottom line is this is kind of what happens every 4 or 5 generations. And we are in that situation right now. And so when you say, is the government going to keep bailing out? They have to keep doing that unless they're willing to just step aside and let chips fall where they may, which I think politically, no government is going to be able to do that. And that's why things like that just happen. I mean, they happen despite the actions of governments as opposed to because of the actions of governments. Well, of course, they happen because of the previous actions of governments. And that's the other point. What is happening now can be seen based on previous behaviors. It's sort of like with cancer. I mean, or heart disease or heart attack. I mean, heart attack is the outcome of prolonged hardening of the arteries. It's not something that happens. I mean, sometimes, rarely, it happens just out of nowhere, but it usually doesn't happen out of nowhere. Mm-hmm. It's a crisis born out of a condition. And so the condition, which is excessive indebtedness, which is zero interest rates that have caused misallocation of capital, which is the rise of competing geopolitical other empires, or whatever you want to call them, competitors, and pressuring the hegemonic power of the United States from the financial, from the military, from the geopolitical side. All of this is happening at the same time. And I think that it's difficult to see how this does not result in the same type of an outcome that has happened every time in history these conditions have come together. Again, not in our lifetime. So it's not in our personal experience, but if you read history, it's pretty clear what the situation is and where it might be going. Not specifically, because that we don't know, but in general, reorganization, let's call it.
Mm-hmm. Simon, you mentioned interest rates rising in there. And when we look at the bank failures so far, going back to the idea that you presented about idiosyncratic versus systemic risk, it almost seems as they're trying to explain away each of these bank failures as idiosyncratic, as contained. Yet, as you were explaining that to me, it seems to me like the more systemic risk of all of this, the more systemic piece that has set off a lot of these issues that we've now seen so far, is this rise in interest rates. So how fragile is a system when we get to 5.25% interest rates, yet we're seeing many pieces starting to crumble, the maybe pieces of that avalanche starting to tick off here and there. Does that really speak to the resiliency or the fragile nature of this system at this point?
It speaks to inherent fragility. In other words, built-in fragility. Mm-hmm. The crisis of 2008, 2009 is now 15 years behind us. For 15 years, or for the first 14 years of those 15 years, the Fed has tried, but has been unable to normalize rates. They've been unable to enter from these extraordinary policies of quantitative easing, which is basically printing money, and massive deficits. Like, think of what a deficit is. A $2 trillion deficit is $2 trillion that goes into goods and services that otherwise would not have existed. So, why do you see? I mean, these are all very common sense type things if you just think about them. Like, why every time there's a panic, there's no toilet paper on the shelves? I mean, it's very simple, because supermarkets and the entire supply chain has inventory management systems, and these inventory management systems manage inventory to the level of most recent demand, right? I mean, people buy so much toilet paper per week, so maybe they have some margin of safety above that, but as soon as demand spikes, there's no toilet paper. Now, it's not like the toilet paper doesn't exist. They can make more. There are many trees they can go, but it physically cannot appear out of nowhere. It's the same thing. It's the same thing with everything. It's the same thing with money. It's the same thing with rates. So when the government is spending $1.5 to $2 trillion in the United States, deficit spending, the entire economy is geared to accept that money and to deliver goods and services against that money. So as soon as you start withdrawing that money, somebody has to shrink production. Mm-hmm. The demand then shrinks. And as the demand shrinks, then everybody who's geared, the reverse happens. Everybody who is geared for a certain level of demand, all of a sudden finds that they can't sell their stuff. So now they have to lay off workers, they have to liquidate inventory, they have to. So it's like it's a Ferris wheel from which you can't get off, mm-hmm. is really what it is once you get on it. It's like a squirrel in a barrel, has to keep running. Mm-hmm. To keep things going. So there's really, by creating these conditions, these policies, the governments thought that they could exit from them when times got better. But as I've believed for a long time now, the crisis of 2008 was a command crisis that should have been used to clean up the system. And instead, it was wasted on preserving the existing system, this financialism, where debt was used to subsidize consumption. So in other words, growth was coming through from credit growth. not from real growth. And so if you have to keep growing, and if you have to keep growing credit to keep growing, how do you service all that debt if rates go up? Because think about it. I mean, in 2017, I think I did a TED talk where I showed this trick that the government's been doing, where in so it was 5-6 years ago, the level of debt service for the U.S. government was the same or lower than it was in the 1990s, even though debt was multiples higher. It's because as the rates go down, you can carry more and more and more debt. But then as inflation showed up, the Fed was forced into raising rates, and then the consequences started appearing. So it's not like they say, "Oh, the Fed did it." These policies are baked in. It's just a question of when they have to be implemented. Mm-hmm. It's like if this happens, they have to do this, and if that happens, they have to do that, and if they don't do that, then other things will break. And so it's almost like, I mean, I don't want to say deterministic, but in some way, it's a deterministic path. That if this happens, then that will happen. And if that happens, then this will happen. And then you can gauge as to what is likely to happen. And you can see, well, if the next thing to happen is going to be this, then the band of outcomes becomes that, and then it becomes bigger and bigger and bigger. And that is where we are. And I don't want to make it complicated because the mechanics of it are very complicated, but the concepts are for anybody to figure out themselves. It's just arithmetic. It's not even math. Mm-hmm. There are no complicated equations here, really. It's, you can see that if in 2017 the government was paying the same, whatever it was, $400 billion, then now it's going to be paying $1 trillion. Mm-hmm. What's $1 trillion? $1 trillion is 25% or 20-some% of the federal receipts. So the government is spending, basically is borrowing, 20, 25 cents of every dollar they spend. Well, just think about it. How long is that going to go on? So it's been going on for a long time. And so people say, well, it's going on for 40 years. Why wouldn't it go for another 40 years? That's because all good things come to an end. That's why. Mm-hmm. Because at some point, the math gets complicated. Now, as I said, there are multiple factors converging. So one of them is geopolitical. And that's external pressure that we do not fully control. Now, we like to think that we can control it, but we really can't fully control it. And so that is something that's pressuring the United States and the Western alliance in general. And of course, the other side is not stupid. They know the weak points. And so this is a financial war as much as a Cold War and as much as a trade war and as much as any other kind of war, as kinetic war. Mm-hmm. And we have to allow for that because the objectives of the other side are very clear. And the dollar is in their sights, which we can talk about, and that's a factor that complicates the ability of the government to handle domestic issues because higher interest rates are necessary to keep attracting deposits. Mm-hmm. Because again, there's counterparty risk. Because the counterparty risk of the United States has become the fact that the United States has started confiscating people's reserves of countries that we don't like. Maybe we don't like them for very good reasons. But, if you're banking with somebody and then they say, I don't like your politics, I'm going to take your money. Well, then perhaps other people who think similarly to you look at it and say, well, I don't want my money taken. Maybe I need to find a different place for my money. Mm-hmm. And so, as you can see, last year, demand for gold from central banks was the highest since 1967 or something like that, in 55 years. Why? Well, in part because of counterparty risk. Because just like depositors are running out of regional banks, sovereign depositors are, looking for alternatives to depositing their money in the US dollar system. Mm-hmm. And that's, one of the dynamic that's going on here. That's not helping what's going on inside the financial system in the US.
Mm-hmm. Maybe before we get to the de-dollarization, and the geopolitical picture, Simon, I just want to, maybe wrap up a little bit of that, the other subject we were talking about with interest rates and everything, by talking about how you see inflation. You mentioned trillions of dollars of deficit spending per year. And then we add on top of that the reduction of the balance sheet, rising interest rates, and then the second and third order effects of that, which have been these bailouts. So when we add all of these things up, this seems to be, another growth in the money supply. Do you see that as, the next step or the next evolution in growing inflation again? Or how do you see the inflationary picture going forward from here?
First of all, inflation has become a term of art. It is used to describe CPI, Consumer Price Index, which is the index with a very specific formula that keeps changing depending on the exigencies, political exigencies of the moment. So instead of talking about quote unquote inflation as it's defined by the Bureau of Labor Statistics, why don't we talk about the cost of living, which is experienced inflation. Now, of course, it's different for everybody because there are different parts of the world and part of the country, and people have a different basket of what they consume. But this is a question that has to involve geopolitics, because what we're watching in front of our eyes unfolding is a radical deglobalization. We have been in radical globalization, where the United States was able to outsource most of its consumer manufacturing, for example, to China and to other cheap, labor markets. And now we're finding, as this kinetic war in Ukraine started, that we don't have in the West, not just in the United States, but in Western Europe as well, industrial capacity necessarily to replace all the armaments that are being expended in that war. So what that leads to, and has already started, and again, I'm not saying anything that hasn't been said by even Janet Yellen and others. She called it friendshoring, reshoring. Essentially, what we're dealing with, and this is a secular trend for a number of years to come, because you can't deindustrialize and then reindustrialize in 20 minutes. We're looking at industrial policy in the United States, and there are beginnings of it where the government is allocating money to certain, industries that need to, whether it's chips or whether it's, energy or whatever, that needs to be rebuilt. Hugely inflationary, not CPI inflationary, really inflationary, because ultimately it's just, think about it again, common sense. The costs are higher. I mean, if we're going to bring stuff to Mexico or to the United States, just think about the regulatory costs, the healthcare, labor laws, real estate prices, construction, labor, whatever. I mean, take anything. I mean, try to build a factory here and produce a product for the same price as it was being produced in China or Vietnam or some other place. That's just not possible. Energy and food, same thing. European industry was feeding off of cheap Russian energy. That is not the case. So what's happening now is a couple of things, and they're not long-term sustainable. So on the one hand, Russian energy is now going through black market to Europe. To say all of a sudden there's a surge in Indian oil and Kazakh oil, and oil coming from places where it's never come before, which of course is repackaged Russian oil at much higher prices. So that's happening. The food, I mean, Russia is a huge supplier of food and energy. Given what's going on there, I mean, there's no way that it's not going to be more costly, and that replacing it with liquid natural gas from the United States or whatever it is just more money. It's just everything is more expensive. War is inflationary. We are at war. We're in a real war. I know everybody thinks in the West that this war in Ukraine is sort of like Afghanistan and Iraq, which were terrible for the people there, but really didn't affect people at home directly that much. But, Iraq and Afghanistan are not the largest or second largest exporters of, oil, food, rare earth metals, and all kinds of stuff. I mean, that's just not the case. So we're dealing with a major reshuffling of the global supply chains and deglobalization. And that, I think, is strategically highly inflationary. It's going to cost more. And on top of that, I didn't say, but European governments have spent this past winter like $800 billion or something subsidizing the energy costs to the consumers and businesses, which is an extravagant sum of money. So can they do this for years to come? Because so far, there's no sign that the situation has changed or will change next winter or the winter after that. So I think that's everything that you and I are talking about cannot be sliced and diced and separated in separate things, because it's all part of a much bigger convergence of trends that are all happening at the same time, and they're all interconnected and they're all impacting each other. And that's why the central banks are loading up on gold, and that's why, and we can talk about what about gold makes it attractive for that particular situation. Mm-hmm. But that's why we are seeing it, but we are not seeing anything like that in the U.S. or North America or even Western European investor level. Mm-hmm. No reaction of that sort.
Yeah, it's really hard to be able to actually separate any of these trends, right? And again, going back to something that you've said recently, when we hear the word collapse, it seems like maybe an acute or a sudden event. And yet many times it takes years for this process to really play out. So as we think of all these processes, let's say of de-dollarization or deglobalization, do you see these topics as slowly building then all at once type of events?
The question is what happens all at once? I mean, the outcomes here can be here from bad to really bad. I mean, the fact that they're going to be financially bad, I think that's baked in the cake. I mean, we've borrowed the money, we've spent it, it's gone. Somebody has to take a hit. Now, that's very simple. Every dollar of somebody's debt is a dollar of somebody's asset. I mean, Luca Pacioli invented double entry accounting in the 16th century, I think. And so for every debit, there's a credit. That's just the way it works. So people say, oh, let's have a jubilee. There's going to be a jubilee. All the debts are going to be canceled. Oh, all the debts are going to be canceled? Uh-huh. So whose assets are these debts? Oh, it's the pension funds. It's the insurance companies. It's where everybody's savings are. It's the mutual funds. It's the index funds. It's our money. It's all our money. We've financialized this world. Pension savings are no longer savings. They're investments. They're invested in the market. They're invested in the bond market. The 60-40 portfolio, stocks, bonds, has bonds in it. Okay? If there's a jubilee, those bonds are worthless, or they're worth less, a lot less. So there's no such thing as canceling the debts without tanking the entire financial system and essentially the savings of a generation, several generations of people. I mean, there's just no way around it. And that's the tragedy of what is going on. And that's why it's been, sort of been talking about it for, 10 years now. But people, I have a great quote, I think from Tolstoy. I just reread War and Peace, that kind of explains why you and I keep talking about these things, but it doesn't seem like anything's happening outside. So, of course, the relevance of War and Peace today is that it's about the Napoleonic War and the invasion of Russia, and it all takes place very much in the same part of the world where terrible things are happening now. And the dynamic and the role of individual in history and the analysis of historical processes in general is very relevant to what we're seeing. So this is what Tolstoy says about how people typically react to approaching danger. What he says is, at the approach of danger, there are always two voices that speak with equal power in the human soul. One very reasonably tells a man to consider the nature of the danger and the means of escaping. The other, still more reasonably, says that it is too depressing and painful to think of the danger, since it is not in man's power to foresee everything and avert the general course of events, and it is therefore better to disregard what is painful till it comes, and to think about what is pleasant. This was written in the 1860s. Okay? How is that different from what's going on today? So there's nothing new under the sun, and human nature has not changed. And so you and I can be having these discussions, and I know you have these discussions with other people, and there are some alternative channels. I call them alternative because they present different sort of view of the world than, let's say, CNBC or MSNBC or even Fox or mainstream media. But if you listen to them, everything's pretty much okay. Jamie Dimon was on this morning saying, I think the banking crisis may be over, but we might have to do a little more lifting. And if you listen to what he's saying, he kind of is saying all these things, but he's saying in such a benign and smiling way that people think, it's designed to make people like, yeah, well, there's a problem with banks. We may have to do a little heavy lifting here. Yeah, those stress tests really were not stressing anything. They were just stressing it to, low interest rates going up just a little bit, and they went a lot, so we didn't expect that. But, the future is bright, and yeah, real estate might be a problem. Commercial real estate might be a problem. We'll have to deal with that. We'll have to deal with that. That's the largest bank that's sitting on untold amount of exposure. I mean, when people say, "Oh, this is just a regional bank," why? The regional banks lent the money on the moon. They have different loans to different people in different economy or something. Mm-hmm. No, the too big to fail banks have all the same assets. They're just bigger. It's just more, and the government stands behind them. They think, or we think. Who stands behind the government? I ask. That's the question. And that's the question everybody should be asking. But they're not asking because of what you just saw. And by the way, you can see it in the demand for gold. When you look at the North American ETFs, which are the typical ETF, the GLD, SPROT, and a few others, and I look at them as opposed to the world because European ETFs didn't even come online till later. So there's more growth relatively in those. But when I look at 2012, which was the last peak of ETF assets when the price of gold was in the 1700s there, last time, $97 billion worth by dollars in North American ETFs. Today, it's 110. Nothing. Mm-hmm. Look at the expense. So this is by dollars. By weight, by tonnage, a couple of percentage higher today than it was then. So in other words, same tonnage. The value is a little higher because the price is whatever it is, 2030, as opposed to 1700 or 16 something. So people have not been buying insurance. And I use ETF as a gauge to see portfolio investor interest and exposure to gold. Mm-hmm. There's no interest. Why? Because of the quote we just read, because of the approaching danger. People just think pleasant thoughts. It's easier to think pleasant thoughts than to do something about it. Mm-hmm. And in the meantime, gold is the only financial asset that doesn't have a counterparty risk. So obviously, when government keeps telling you, don't worry about your deposits, the counterparty risk is there, but you think the government is taking care of you. So you're not worried about it, but maybe it's time to worry about it. But they aren't. And that's where we are. That's the reality.
Well, and, going back to something that we were talking about the, let's say, the inaction or the track record of how these things are presented, how many times did we hear that inflation was transitory or that we're not even thinking about raising rates yet? It doesn't fill me with confidence to hear them say, oh, the banking system is shored up, everything's perfect, don't worry about it. It seems like we should be believing that the opposite is true. Go ahead, Simon.
Yes, no, of course. But people, like I said, we just read the quote and it describes the psychology mm-hmm. of the situation that we're in very clearly. This collapse, or whatever you want to call it, this transition. And again, collapse, people get turn their ears off basically when they hear talk like that. And that's why I try not to use these words, because what is a collapse? Unless it's there are people running with guns down the street. It's just like, what was the Great Depression? Was that a collapse, or we call it the Great Depression? Unemployment was 20-some%. Well, 80-some% or whatever, 70-some% of people were working. Mm-hmm. And they were scared for their job, but they were working, and they were, maybe not making as much as they would, and not in the job they wanted, but they had to do it because they had to feed the family. Or was it a collapse? Well, I mean, in a way it was. It was a collapse of a system that emerged from that depression, a very different system. I mean, the Social Security, the great social programs, tremendous interference of government in industry and industrial policy, infrastructure projects, picks and shovels, ready shovel projects, whatever they used to call them, which came and went, into the night from whatever it was 10 years ago, shovel ready projects, if you remember that. So it just keeps going until there's phase transition, sort of like boiling water. You start seeing a little swirling of the water, but it actually doesn't go to roiling boil until it goes to roiling boil. Mm-hmm. So you see the signs, but that last minute when the water, that's phase transition. This is when the molecules are activated enough where they start emitting the chemistry is my college first couple of years of college, so I remember all that. You start seeing the vapor coming up, but this is really, I mean, I know it sounds like it has nothing to do with what we're talking about. It has everything to do with. If you carefully watch the water as it heats up, it's placid, but you start seeing the movement under the surface, and then you start seeing little ripples on the surface. And all of a sudden, the next thing you know, it's roiling boil. Mm-hmm. That's the dynamic of these types of events. And that's the dynamic of what's going on with the banks. Okay, the first bank, they bailed them out. The second bank, they bailed them out. So all of a sudden, people were very nervous the first weekend. Now they're not as nervous in these weekends until something else happens. And something else might be that the government says we can't. And they said that from the beginning. We're going to bail out systemically important institutions or their depositors, but maybe not others. So maybe they come to a point, not in too distant future, where they say, well, we can't bail this out. So we're just going to let chips fall there they may. And then all of a sudden, there's a phase transition in people's mind. And they go from, maybe this is a problem for me. Now, right now, it's a problem for somebody else. But it's not a problem yet for me. But the distance from a problem for somebody else, but I already see the problem. So all of a sudden, oh my God, this is really a problem, and I can lose my money. Mm-hmm. That happens very quickly. That's what a run on the bank is. So it's happening digitally. You can't see lines on the street. People are doing apps. Right now they're staying within the system. They're going into money market accounts. They're going to the too big to fail banks. But but as this crisis keeps creeping along, mm-hmm. we're going to see bigger and bigger repercussions to the moment when there will be a crisis of confidence. Unless something very big happens to change everything, which is difficult to envision because it's all kind of baked in the cake with the debts and the interest rates and all that. That's the path that we're on and have been for a decade or over a decade now, 15 years.
So Simon, going back to the gold price, you're saying that there has been some interest in gold, obviously, by the ETF flows, relatively small, let's say, to what maybe we think it should be. Central banks buying gold at record rates. So what is explaining to you the relative strength in the gold price right now? We're less than $100 from the all-time high. Is this the recognition by some that counterparty risk is a real issue here? And what do you think happens when we get to that crescendo moment of the actual crisis really presenting itself and affecting people and their actual finances?
The dynamic of gold price, first of all, the answer to your question is there's increased interest because gold is a function of supply demand. Mm-hmm. But at the same time, it's clear that the amount of interest that's increased is tiny compared to the amount of outstanding financial assets, which at some point people would want to exchange for something that doesn't have counterparty risk, right? So the insurance dynamic of gold, again, totally common sense. Just because people don't rush to buy insurance. By the way, nobody wanted to buy insurance in subprime mortgages, except for a few people. I remember that very clearly. And people, us and other people suffered terribly in 2006 when the value of insurance was declining steadily, even as the risk was increasing exponentially, because nobody wanted to recognize the problem, and we're thinking happy thoughts. Somehow it's all going to work out. So the answer is you can extrapolate that if a small pickup in interest can cause the magnitude of the move, which say from the low of October is now at 20% or something. It was in the 16, 30, 40 or something like that. And now it's $400 higher. You can just imagine what happens in a situation where suddenly a larger portion of people decide that this is something they want, that they want protection from counterparty risk. This goes back to the toilet paper discussion. The gold, particularly physical gold, the difference between demand for physical gold bullion and demand for gold derivatives is essentially counterparty risk. It's the assessment of counterparty risk. Mm-hmm. And while people are speculating on what other people might do in the future, which is what drives the price, has been driving price so far, they are not so worried about counterparty risk. And so a lot of the speculation takes place with leverage based on real rates, based on expectations of inflation in the derivatives markets, somewhat in the ETFs. But as I just explained, ETFs have not seen major inflows. I mean, they've seen some. In fact, until the failure of the Silicon Valley Bank, gold ETFs were having outflows year to date. And they had negative flows last year, and they had negative flows the year before. So 21, 22, and 23 through half March, let's say, the net flows into gold ETFs were negative. That just tells you what the net sort of interest of investors has been in gold. So then they turned positive, reversing the negative year to date. But they still, like I said, everything that they own today is barely higher than 10 years ago. And you can look at the expansion of monetary base, of the financial assets, of how much money has been printed, how much debt has been increased, and all that kind of stuff. Of course, so obviously people don't see the problem or see the problem, not ready to do anything about it. So this insurance dynamic that I just described, that I started describing, comes from the following. The moment when it comes from a couple of things. One is the moment when this penny drops, when the moment of clarity arrives, and enough people realize that they want some insurance, they want to swap counterparty risky instrument or instruments vis-a-vis risky counterparties into counterparty risk-free instrument, which is physical gold, physical silver, physical platinum, mostly physical gold because of its feasibility, high value per unit. What happens to the psychology of people who already own gold? They're now being asked to give up their insurance in exchange for financial instruments that have counterparty risk, that the person who wants to take it from them wants to get rid of. At what price at that point? Are they willing to part with their insurance? The second factor that I mentioned to you is with toilet paper, which is that the physical gold has supply chain, just like everything else. About $200-300 billion a year is mined, and that's always for sale. Mm-hmm. But it's spoken for, basically, because of the central bank demand and other demand. So any marginal supply has to come from people who already own it. But in what form? So there's 50-60% of the gold is in jewelry. So then you start seeing people running around with these sandwich boards. We buy gold, right? So to gather up this gold and then send it to the refineries and produce gold bars that investors can buy. Well, guess what? There's so many refineries and they can work 24 hours a day. It's 3 shifts. There's a capacity constraint. Mm-hmm. So you're dealing with the same thing as with toilet paper. When demand spikes, there are bare shelves because the supply chain is not geared for the level of increased demand. It takes time for it to gear up. It's maybe months of lag times. by which time the price is determined in an auction, just like with Picasso. If 10 people walk into Christie's and they want to walk out with that Picasso, or whatever that painting is, or whatever that object is, the highest, the guy who is willing to pay, or the person who is willing to pay the most, is the one who's going to walk away with it. Mm-hmm. Okay, it's not like this complicated auction with a lot of different things. Like, I want that. There's only so much of that. Okay, what do you want to pay? And so that's the insurance dynamic. So at the moment when insurance becomes valuable, obviously, to people, and they start desiring it, is usually when the risk becomes undeniable, real time. And at that point, supply collapses just as demand spikes. And so that's how it works with gold. It may not work like that in like moment by moment basis, because when markets, let's say, collapse or tank, sometimes people have to sell gold who own it to meet margin calls and whatever. Mm-hmm. But that's a very moment. So it's for people who for trading, I don't make any recommendations. But in terms of longer term trend, I mean, that's clear. Demand, and we can see it. We can see it with central banks. I mean, the arsonists are the first to smell the fire because they know what's coming. They're the ones. Yeah, well, they're the ones that are buying it hand over fist. They want to diversify away from the dollar because of the geopolitical issues. Because the United States has been using the dollar as a tool to squeeze, through sanctions, Russia and so forth. And at some point, it gets to a place where other people start thinking, well, I'm not doing anything wrong, but what if I decide to choose between, say, alliance with Russia and China, and then they're going to take my money from me? Well, that's not a comfortable position people want to be. So a lot of non-aligned countries are obviously having serious thoughts about where their reserves ought to be and what currency they want to transact in. It's a long process. It's not something that happens overnight, but just like with anything, people need to understand that this process we're dealing with is not purely financial utility. Mm-hmm. These are geopolitical drivers. I mean, exigencies of war sometimes usually overcome financial considerations. So people who think that dollar is inviolable point to the fact, well, there are no deep markets in any other currencies. There's no liquidity in anything. It's all true. Under normal circumstances, it's all true. Mm-hmm. But if there's a war, then people take completely different decisions for national security reasons that have nothing to do with financial benefit. And that's the danger. This is a huge danger of where we are right now, and the convergence of these trends. So this geopolitical trend is a major factor in what's going on. And so we may think it's irrational to abandon the dollar in exchange for some currency that we don't trust, say yuan. But for countries that feel squeezed, it's a different decision matrix for them. And we have to understand that our view is not the only view in the world. Mm-hmm. There are other people that have different ideas and different priorities and different national interests. So I think we're in a very precarious situation. And I think it's developing in front of our eyes, frankly. Mm-hmm. Big changes, very big changes.
Simon, I'd like to approach that, let's say that the gold question from another angle, just to kind of isolate how we're thinking about this. When we see interest rates typically rise, that typically makes the dollar more attractive. Yet we've seen, some excellent gold strength here in this rising rate environment. So what happens when interest rates are actually paused or start to fall? Is this more a recognition of the brokenness of the underlying system rather than the underlying rate change driving that demand in gold when rates start to fall?
This is an excellent question because it goes to the heart of the cyclicality that we're talking about, these super cycles. Gold has been trading against real rates for 40 years. And so in the financial markets, you see everywhere these charts and they say gold is highly correlated to real rates. But just step back and think for yourself. Again, don't take what I say as a given truth. Just think for yourself. So if you have an opportunity to earn a certain return, right, and versus an asset that provides safety but does not provide current income, you're indifferent only so long. You're indifferent as to which asset to hold and go for the highest return, only so long as you think that higher return is not offset by higher risk, or more than offset by higher risk, right? So in other words, you're willing to make this choice between two different counterparties, or one having no counterparty and the other is counterparty, so long as you're comfortable with the counterparty. So for 40 years, government securities were deemed to be risk-free rate, it's called, right? Well, now we're in a situation where potentially dollar has risk. It has counterparty risk. Now, counterparty risk involves both credit risk and both expropriation risk and, devaluation risk and other risks beyond the interest rate. And so we are seeing, I think, with this transition of rates going up, dollar hanging in there, even though it's down from its high, but hanging in there, but gold suddenly performing, it's because certain people are making a choice between the dollar and something that doesn't have counterparty risk, based on counterparty risk, not based on how much money I'm going to get every quarter or every month in a coupon. Mm-hmm. That's what's happening. So I think that's a very good point to address, because I see it as a telltale of the recognition, not yet in the Western investor's mind usually, because of what I just said about the ETFs and the demand for physical gold in the West, but it's clearly happening around the world. And it's happening to the extent that gold price continues to go up, or at least not go down, despite what otherwise, looking at correlations, would have been, slam dunk. Oh, gold should be crushed. I mean, I can earn, I can earn real return on cash even, maybe, or at least, not lose money to inflation. Inflation is whatever. Let's say they say it's 4%, and I can get 4% in the money market account. Hey, I'm doing well. But obviously, different considerations are coming in. And that's the thing about gold. If you look at the longer term picture of gold, it is not correlated to anything. Now, what it means is, it's not that it's never correlated to anything. It's just that correlations change. Sometimes it's correlated positively with the stock market. Sometimes it's correlated negatively with the stock market. Sometimes it's positive to real rates. Sometimes it's not correlated to real rates. And that's what's important for longer term allocations to gold, is that this is genuinely an uncorrelated asset. It exhibits correlations in periods of time and different cycles, but it does not exhibit any predictable correlation over a long time. And if you're talking about multi-generational wealth preservation, if you're talking about pension fund type assets that have long-term liabilities, that's a major stabilizing force, an uncorrelated stabilizing force for a savings or portfolio of people. But of course, we've been in a 40-year situation where everybody wants everything working for them every minute. My money is not working. It's opportunity cost. Okay, but if you look at the fullness of time and what your objective is, and it all depends on age, of course, but if your money is meant to be somewhere available to you, 20 years from now, 15 years from now, 30 years from now, I mean, look around you today. Where would you put money and say, I can come back in 10 years and it's going to be there, and it's going to buy about what it's buying today, at least, maybe probably more? Mm-hmm. What exact security would that be, given the level of uncertainty that we're in? Could it be stocks? Would it be bonds? I mean, it's really, if you think about it, it's hard assets. It's the timeless values, be it paintings or be it gold or silver or platinum or I don't know, land or things that are not going to be, that don't have risk of permanent impairment. Well, counterparty risk.
Some might say that we would have a biased answer towards that question, but why not it? Why wouldn't it be Bitcoin?
Well, do we know that Bitcoin is going to be around in 10 years? I mean, I know that people say, of course, but let's say it's been around for what, 15 years? I have a question. If it's been around in 15 years, look at the internet over 15 years. So World Wide Web, I think, showed up in 93 or something like that. Add 15 years to that and see what happened to that space in 15 years in terms of its penetration into everything. Mm-hmm. Businesses, commerce, government, economy, personal communications, everything. So the question is, Bitcoin is there. It's still there. And it's higher priced than it was before, let's say, even not as high as it was at one point. Mm-hmm. But where is the penetration to the mainstream? Relative, I mean, it's 15 years. This is a very long time. So the question is, between that and the fact that the governments are clearly sharpening their knives against crypto, and by the way, that's a natural outcome of what we've been talking about for the past hour. Mm-hmm. You know, if there's a threat to where people can run outside the financial system, I mean, crypto is one place. Now, gold is another place. But the thing with gold is it's a reserve asset for all of the world's central banks. And so just because the United States, let's say, doesn't like gold, or Canada doesn't like gold, it doesn't mean that Asia doesn't like gold, or that it's going to prohibit it or something. Whereas with crypto, we're not sure what governments exactly, other than, you know, a couple, embrace it truly. So it has a much tougher fight. So the history isn't there. We haven't seen how crypto is done through a real systemic crisis. And we will find out. Maybe it'll be a huge survivor, but maybe it won't be. So we're talking about level of certainty here. We're not talking about the hopes. And I think this is what's going to happen. I mean, we know what has happened with gold through crisis and crisis and crisis and crisis, and what is happening to it right this minute. Mm-hmm. How the governments are loading up on it in the face of this crisis. Well, we're not exactly seeing that with Bitcoin at the moment. And again, this is not against Bitcoin. This is just, it's not a proven performer. Mm-hmm. I mean, we don't know. We'll see. We'll find out.
Yeah. I was going to make that point, that this isn't necessarily to bash Bitcoin or to say that that it's not going to perform. I think that we need to be able to take a step back and have a more divorced and sober view of any of these asset classes, and, you know, ideally be able to analyze them on a case by case basis, dispassionately.
I'd say one more thing. As we saw with all sorts of prosecutions, government seems to have a pretty good ability to get their hands on other people's Bitcoins and you know, wallets and things like that. Gold is a cyber immune asset. I mean, it's physically can be located in different jurisdictions, and it cannot be retrieved from that jurisdiction unless physically somebody goes there and retrieves it. You know, you have to send the Marines, in other words. Whereas with, we shouldn't say Bitcoin, I mean, with any digital asset, mm-hmm. It lives online. It's a digital native, right? So just as it's convenient not to have a particular location where it is for people who own it, it's also convenient for governments that it's not in any particular location. It can be retrieved from anywhere. You know, so this question of cyber immunity against the potential financial repression using very deep cyber capabilities of the intelligence agencies and military agencies and national security agencies of all sorts. You know, we don't know how that holds up. We just don't know. They haven't tried. You know, they haven't tried it. So just because you can't crack the blockchain itself, it doesn't mean that the entire infrastructure that's supporting it, the mining infrastructure, the rigs, the chips, the internet service providers, the access to the internet, you know, the monitoring of the internet and all that. Those are all unknowns, and I think that people who are convinced that this is definitely going to work I mean, you need to step back and think beyond the trade and think in terms of like, can I bet everything I own that it's going to work, or should I, think more in terms of like this is a bet, and this is a more of a sure thing, more of a proven thing than crypto. I mean, so it's not. I'm not against it. I'm just saying, like, we don't know. I mean, we're going to find out. But I think in times like this, you want something where you have some level of confidence as opposed to hopes and thoughts.
Mhm.
You know.
Yeah, I mean, again, we could spend hours discussing the good things about Bitcoin, the portability of it, the transferability of it, which can also be a good thing for gold, as you mentioned. Simon, I really want to thank you for being so gracious and so gracious with your time today. Is there anything you'd like to mention before we wrap up here?
No, I mean, I think everybody needs to make their own decisions. In the end, people need to be responsible for their own savings, and for those who count on them to be responsible for the savings of the family or the company or people who've entrusted them with savings, and not be a deer in the headlights. But like I said, I've been saying this for many years. Some people react to it. Most people listen to it and say, yeah, whatever. I think we're in a very difficult predicament, and I think it's unfolding in front of us. I think it's going to continue to unfold. Just as it's difficult to look back beyond 2019 pre-pandemic and realize how much change has happened, I think we're going to look 3 or 4 years from now. We're going to realize the world was a very different place, in many, many, many ways, geopolitically, politically, economically, financially, and to navigate through that transition and through the cycle that we're in. I think it's important to have reserves, independent reserves. How people, where they want to get them is up to them. But I would give it a very serious consideration that clearly people are not giving. Despite listening to all these videos and programs, the vast majority of the people are going about their lives doing the things that they've always done and not paying attention. I think people should pay attention. I think it would pay off if one pays attention.
Absolutely. And I want to thank you again for helping give a different perspective for people that might not be taking action at the moment. Of course, Simon, you're available. You have a very active and excellent Twitter feed at S_Mikhailovich, which we'll put in the show notes, and bullionreserve.com, right?
Yep.
Wonderful, Simon. Thanks so much for your time today.
Glad to be here.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.